Tencent just posted record-breaking profit margins. I mean, we were talking about a quarter where they extracted massive profits from a captive audience of like 1.4 billion users.
Yeah, it's a staggering number of people.
Right. So why did their free cash flow suddenly plunge by 13 billion into the red? Well, welcome to the artificial intelligence arms race.
It's really the ultimate corporate paradox. On the surface, you have this unstoppable monopolistic cash machine, but underneath, they are just hemorrhaging capital to secure their survival in the next computing paradigm.
And untangling that exact paradox is our mission for today's deep dive. We are looking at a brand new comprehensive financial research report on Tencent Holdings. That's ticker 0700 in Hong Kong, or TCEHY over the counter. This is hot off their Q2 2026 earnings released just yesterday, August 13th.
Yep.
We're going to break down how their AI is actually driving unprecedented ad revenue, figure out where all that cash is suddenly vanishing to, run the stock through a brutal value investing stress test, and finally, calculate a strict discounted cash flow valuation to see what this behemoth is actually worth right now.
It's a fascinating look at what happens when a legacy software empire is basically forced to become a massive buyer of physical hardware, I mean, almost overnight.
Totally. Now, before we jump into those underlying mechanics, a quick note for you. To access more advanced research, companion for modern intelligent investors, and leverage our latest Deep Values agents, welcome to download Deep Values app from App Store. To track stock market temperature, welcome to download iOS app Buffett Indicator from Apple App Store or Bubble Watch from Google Play. Disclaimer: all analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for research and entertainment purposes only and does not constitute any investment or financial advice or service. Conduct your own due diligence before making investment financial decisions. All right, let's look at the sheer scale of the operation before we get into the cash flow shocker.
Yeah, we have to set the baseline first.
Because the top-line numbers for Q2 are just staggering.
They really are. Total revenue hit 204.8 billion RMB. That is a solid 11% year-over-year increase. And what is critical for you to understand is that this wasn't, a fluke driven by one viral game. Right, it was synchronized.
Exactly. Synchronized structural growth across their three main pillars.
So let's break those pillars down so we can see where the money's actually coming from. The biggest chunk, about 49% of revenue, is value-added services.
Which is their historical engine, right?
Yeah. Gaming and social networks. It grew 8% year-over-year. But gaming in China is supposed to be this entirely saturated market. How do you squeeze an 8% increase out of a mature demographic?
By fundamentally restructuring how they monetize. I mean, they saw a 17% resurgence specifically in domestic games. They've optimized the monetization of these massive evergreen titles, and they paired that with highly successful new releases like Delta Force, Valorant PC and mobile, and Roco Kingdom World.
So they're just exceptionally good at keeping players inside the ecosystem.
Very much so.
So the legacy gaming machine is humming, even with some currency headwinds dragging down the international side. Then you have the second pillar, fintech and business services, sitting at about 31% of revenue, growing 9%.
Yeah, this is essentially the infrastructure layer of Chinese commerce. You have WeChat Pay processing everyday commercial transactions, their wealth management arms, and enterprise cloud services.
And crucially, those cloud services have finally moved past the whole cash burn phase, right?
Yes, they've returned to scalable profitability, which is a huge deal.
Which brings us to the third pillar, marketing services. This used to just be called online advertising. It makes up 19% of total revenue, and this is where I need you to explain something to me.
Yep, shoot.
This division surged 22% year-over-year to 43.6 billion RMB, but Weixin and WeChat already have an astonishing 1.439 billion monthly active users.
Right, the user base is basically tapped out.
It's practically the entire connected population of China. The user base is fully saturated. So how on earth do you spike ad revenue by 22% without just bombarding your users with double the amount of ads?
That is the multi-billion-dollar question, and the answer is the first major commercial breakthrough of their AI investments. They rolled out an upgraded AI-driven ad recommendation model and this automated campaign management solution called AM+.
Okay, so they didn't just increase the ad load.
No, not at all. The number of ads you see on WeChat actually remained below the industry average. Instead, they made the ads exponentially smarter.
I see. So the artificial intelligence is analyzing user behavior so accurately that it only shows you what you're actually likely to click on.
And that completely changes the unit economics of the business. I mean, when your ad targeting is that precise, click-through rates soar.
And advertisers notice that immediately.
Of course. When click-through rates soar, advertisers realize they are getting a much better return on investment, so they're willing to pay a higher premium per 1,000 impressions. Tencent is literally absorbing marketing budgets away from e-commerce rivals simply because their AI model converts better.
That perfectly explains the incredible operating leverage. They are making more money on the exact same amount of digital real estate, and that shows up in the profit margins. I mean, their gross margin hit 57.8% this quarter.
Which is huge.
Just 3 years ago, that margin was 47.5%. A 10-point expansion at this scale is almost unheard of for a mature monopoly.
It proves their transition away from, lower margin operations into high margin AI targeted advertising and enterprise software is working flawlessly.
Okay, so let's summarize the narrative up to this point. You have an apex digital monopoly. They have 1.4 billion captive users. Their margins are expanding beautifully, and their new AI ad targeting is basically printing money.
Literally printing it.
In fact, they generated roughly 68.4 billion RMB in non-IFRS net profit. And just to define that for a second for you listening, non-IFRS net profit is essentially their core operating cash after stripping out weird accounting distortions like stock-based compensation. So we are looking at a company generating mountains of cash, which makes the next part of this report absolutely terrifying. How does a company printing that much money suddenly post a negative free cash flow of 13.8 billion RMB in the exact same quarter?
It is a phenomenal plot twist in the financial statement. Operating capital expenditure, the money they spend on physical assets, skyrocketed by 176 to 190% year over year.
Wow.
Yeah. They blew through roughly 52.8 billion RMB in a single 3-month period.
Hold on. You can't just spend 52 billion RMB on, office supplies. Where did the money physically go?
Servers. Specifically, massive front-loaded prepayments for compute infrastructure. They are buying application-specific integrated circuits known as ASICs and the most advanced GPUs they can get their hands on.
Wow.
Yeah, and management was entirely transparent about this on the earnings call. This isn't an operational failure where the core business is losing money. If you exclude these massive upfront payments for hardware, their normalized free cash flow would have been a highly positive 37.6 billion RMB.
So it's basically a mechanical distortion on the balance sheet. They essentially just pay the rent for the next 5 years of the AI revolution upfront in one lump sum.
That's a really great way to look at it. And they have to pay that rent to train the Hunyuan large model. This is their proprietary large language model, and it is an absolute beast. It's a 389 billion parameter model built on what's called a mixture of experts, or MOE architecture.
Let's unpack MOE for a second, because it's a huge buzzword in AI right now, but the mechanics are crucial. Why does a mixture of experts architecture matter when it comes to the actual hardware they are buying?
So think of a traditional AI model, like a single massive brain. Every time you ask it a question, even a simple one, the entire brain has to fire up.
Which uses an incredible amount of computing power.
Exactly. A mixture of experts architecture is more like a massive hospital. You don't need the entire board of directors and 50 surgeons to look at a sprained ankle. The triage nurse, which is a routing algorithm, sends you directly to the specific expert who handles ankles.
Oh, I get it. Meaning only a small fraction of the 389 billion parameters is actually activated for any given query. So it's an efficiency play to save on compute costs.
Which is an absolute matter of survival, because Tencent isn't just researching AI in a lab, they are deploying it at scale. They have applications running live right now, like WorkBuddy, which is the most widely used office productivity agent in China, and CodeBuddy for software engineers. Every single time a user asks WorkBuddy to summarize an email, that requires an inference token.
And an inference token is just the physical computing cost to generate that specific answer.
Correct. The marginal cost to deliver an extra digital sword in one of their video games is practically zero. It's just pixels. But the marginal cost to deliver an AI inference token is very real. It requires electricity, cooling, and really expensive silicon.
So they had to buy the servers now to handle the traffic tomorrow.
Exactly. It's an inelastic cost. If they want to maintain their monopoly, they have no choice but to pay up.
Which frames the central dilemma for anyone looking at this stock. I mean, we are looking at a company spending massive amounts of capital. So you have to ask, is this a value trap, like a legacy company burning cash just to tread water, or is it a misunderstood compounder?
Right.
And the sources provided actually run Tencent through a classical deep value investing framework to figure this out.
They do. And they use the stringent metrics pioneered by people like Benjamin Graham. They put Tencent through a 19-point stress test looking at everything from debt loads to historical earnings consistency. And surprisingly, Tencent passes 13 out of the 19 metrics.
Passing 13 out of 19 is incredibly strong for a tech company undergoing a multi-billion-dollar hardware transition. But let's look at what it fails, because that usually tells you more about a company's real condition.
True.
It completely fails the Benjamin Graham-style price-to-book ratio.
It fails it miserably. Traditional value investing looks for a price-to-book ratio of 1.5 or less, meaning you are paying very close to what the company's physical assets are actually worth if you liquidated them. Tencent's PB ratio is currently sitting around 3.0.
But the research argues that metric is completely broken when applied to a modern software monopoly, right?
Exactly, because book value only measures tangible assets. Factories, warehouses, inventory, tractors. Tencent is an intangible-heavy company. Book value completely ignores the network effect of having 1.4 billion users logged into WeChat. It assigns zero value to their massive intellectual property portfolio in gaming, and it completely ignores the proprietary data reserves they use to train the Hunyuan model.
Right, measuring a software giant by its physical book value is like measuring the genius of a mathematician by, I don't know, weighing their brain on a scale. You're measuring the physical container, but missing the actual value completely.
That's the perfect analogy, because when you look at the deep value metrics where Tencent does pass, the underlying economics are just phenomenal. We are looking at a 10-year average return on equity of roughly 20.9%.
It's huge.
Yeah, and they have historical free cash flow margins that consistently range between 19 and 39% over the last decade. And despite the massive AI spending spree, they still have a fortress balance sheet with 58.2 billion RMB in net cash.
Which totally explains why legendary value investors, Charlie Munger, Li Lu, Monish Pabrai, Michael Burry, have historically circled this stock.
Yeah.
They look at the numbers and see an unassailable toll bridge monopoly.
Yep.
But there's a reason this stock isn't trading at a massive premium. There is a geopolitical discount applied to Chinese equities, and we really have to address the long-term structural risks the research points out.
We do. The sources outline 3 permanent risks that really cannot be ignored. The first is demographic decline in China. An aging population and plummeting birth rates mean the core demographic for high-engagement competitive mobile gaming is permanently contracting.
It's just simple math. Fewer teenagers means fewer people with the reflexes and free time to buy battle passes in honor of kings.
Precisely. The second risk is state regulatory oversight. The government maintains strict control over the domestic internet. That means arbitrary gaming approval freezes, playtime restrictions for minors, and intense algorithmic transparency laws. It constantly threatens to put a ceiling on their total addressable market.
But the third risk is arguably the most dangerous for this specific AI transition, which is U.S. export controls on advanced GPUs.
Right. This is the bottleneck for their entire AI ambition. The United States is actively restricting China's access to the frontier chips made by companies like NVIDIA. If Tencent is permanently handicapped from acquiring the best silicon in the world, it could severely limit their ability to train models at the same speed as Western competitors.
Even if they optimize their MoE architectures and pivot to domestic silicon, being cut off from the global hardware supply chain is a severe structural disadvantage.
Yeah.
So we have a domestic moat boxed in by international geopolitics. How is management actually dealing with this? Because I know Prosus, their largest and oldest shareholder, is mechanically dumping shares on the open market every single day.
Yeah, Prosus is running an open-ended buyback program of its own, so they are selling Tencent shares to fund it. It creates immense, constant downward pressure on the stock price.
But Tencent isn't just letting the price collapse.
Yeah.
This is where their capital allocation gets brilliant. They are acting like a massive financial sponge.
Exactly.
They are weaponizing that 58 billion RMB cash pile to absorb the selling pressure with aggressive, price-insensitive buybacks.
Just in this second quarter alone, they repurchased 37.4 million shares for 16.9 billion Hong Kong dollars. Management looks at the geopolitical discount, they know the reality of their cash flow, and they realize the highest return investment they can make is simply buying their own company at a discount.
Retiring equity when it's cheap is exactly what you want to see as a long-term shareholder. Which brings us to the ultimate question for you listening to this deep dive. After factoring in the cash flow, the AI spend, the risks, and the buybacks, what is a single share of this company actually worth today? The source has provided a comprehensive discounted cash flow, or DCF, valuation to find the intrinsic value. Let's walk through this carefully.
A DCF simply calculates the present value of all the future cash a company is expected to generate. To be intellectually honest, the analysts laid very conservative groundwork here. They didn't base the math on some optimistic future peak. They established a baseline of 24.0 billion US dollars in normalized free cash flow.
Okay, let's pause there. Why 24 billion?
Because that strips out the temporary distortion of the massive GPU prepayments we discussed earlier, giving us a true picture of the underlying business as it operates today. They assume 9.08 billion shares outstanding, which accounts for the current buyback rate, and they apply a 9.0% discount rate, which is the required rate of return an investor would demand to take on the risk of holding the stock.
Got it. So 24 billion in cash divided among 9 billion shares, discounted at 9%. Now, they ran this baseline through 3 very distinct future scenarios. Let's start with scenario 1, the no growth case.
This is the absolute doomsday model. It assumes Tencent never grows its cash flow by a single penny ever again. It just spits out exactly $24 billion a year forever.
So if the core business flatlines completely and AI adds zero value, where does the stock price land?
Under that 0% growth assumption, the intrinsic value is $30.24 per share.
Okay, so $30 is the absolute floor. Let's move to scenario 2, the conservative case.
For this scenario, they looked at the worst historical growth phase Tencent has endured over the last 10 years. That was between 2021 and 2023 during the severe regulatory crackdowns. They grew at just 3% annually during that time.
Right.
So the analysts asked, what if that sluggish 3% growth becomes the permanent new normal for the next decade?
So if they only manage to scrape together 3% growth, what is the value?
The intrinsic value jumps to $41.85 per share.
Finally, we have scenario 3, the nominal case. This assumes their transition actually works. AM Plus advertising continues to command premium pricing, WorkBuddy monetizes heavily in the enterprise sector, and they return to their historical 10-year average growth rate of roughly 12%.
Right. If they execute and hit that 12% historical growth, the intrinsic value more than doubles to $91.51 per share.
So we have a clear map. $30 if growth dies completely, $41 if growth is severely stunted, and $91 if they return to their historical average. Where is the stock actually trading right now?
It's hovering around 56 to 58 US dollars, which is roughly 350 to 400 Hong Kong dollars.
Which means the market is pricing Tencent squarely in no man's land, right between the conservative and the historical scenarios. It's offering you a margin of safety compared to their potential upside, but it's far above the absolute floor if the business stops growing.
The market is incredibly rational here. It is acknowledging that the core moat is unassailable, but it is aggressively discounting the future growth because of the demographic risks, the geopolitics, and this massive mandatory AI capital expenditure.
It's the cost of crossing the bridge into the next era of tech, really. You have a company experiencing unprecedented margin expansion in its core software day job, but all that extra cash is immediately being diverted to fund a heavy physical hardware transition.
Securing those ASICs and GPUs today to train the Hunyuan model is really the only way to ensure their 1.4 billion user monopoly survives the next 10 years. The capital drain is massive, yes, but it deepens an already immense moat.
Which leaves us with a fascinating macro-level question based on these sources. We're talking about an apex predator spending tens of billions just to stay in the game. I want to hand it over to you for a final thought on what this means for the rest of the industry.
It really makes you reconsider the entire landscape. I mean, if a dominant giant like Tencent with practically infinite resources, 1.4 billion captive users, and virtually zero marginal cost for its legacy products has to endure negative free cash flow just to secure enough compute power for the generative AI era, what does that mean for the survival chances of smaller tech companies trying to compete in this space?
It's a great point.
The financial gravity of AI might just be too heavy for anyone but the absolute biggest players to survive.
That is exactly the kind of question we need to be asking as this technology unfolds. And that wraps up our deep dive on the Tencent Q2 2026 financial report. Thank you for joining us as we unpack the numbers, the mechanics, and the strategy behind this digital giant. Keep asking questions, keep looking past the headline metrics, and keep exploring the data. We'll catch you on the next one.